Welcome to Financial Counseling Unit 4, How and Where to Save. So in this section, that's basically what we're going to talk about, the best ways we can counsel our clients in all the saving options that are available to us. We're going to talk about the tips to achieve saving goals. We're going to talk about the saving process. We're going to talk about mutual funds, retirement accounts, and annuities, as well as major life events. So let's kick it off with tips to achieving savings goals. And we want to stress the need for commitment, because in order to make any kind of savings plan work, you have to be committed. And the first thing they want to do is pay themselves first. How often have we heard that? Pay yourself first. That's so important. Save a percentage of income before they start spending. For some people, it's 10%. Some people think of it as tithes, but that's a separate thing. They can pay the 10% of tithes, but they should also put 10% aside for themselves. And this should be included in the spending plan. It can be done with an automatic deduction from the paycheck, which I, for one, highly recommend. It can be done as an automatic account transfer to savings. You can dedicate a specific savings account just for that. The next thing I want to ask you are, what are some strategies you recommend now to your clients to help them save? So pause this recording for just a minute and take a few moments to write down some strategies that you use, and then we'll see how many that you use that we cover, and maybe you've got some other ways that we don't cover. So that would be great too, but we'll start to build a library of ways we can help our clients save. All right, so I'm going to keep going, but hopefully you took a minute to write down your strategies. Tips to achieving savings goal is start early. So the time in the market is more important than timing of the market. And what I mean by that, if you look at the two examples here, Alita and Corey, they both have the same rate of return. One started at age 22, one started at age 31. Now Alita at 22 only contributed for 9 years. Corey at 31, she contributed for 34 years. So you would think that because she contributed longer, she would, she would have more money, but that's not necessarily the case. If you look with the same amount invested, because of compounding interest, the longer the funds invested, the more your dollar grows. So in this particular example, Alita made almost $50,000 more than Corey did by the age of 65. So starting early is very important. And here's a graph that kind of gives you an idea. Client A, the one with the pink line at the bottom, saves money under the mattress. So she's just putting it away. She's not earning any interest. Client B, the one with the blue line on the very top, invests her money. Both put in their hard work in saving, and they're committed on a regular basis, but client B earns $200,000 more by simply earning a better rate of return. That's the power of compounding interest. Very important. And then there's the rule of 72, which is a good idea to kind of share with your clients. And if you're not familiar with that, you can Google it, but I'll also tell you the rule of 72 tells you to divide whatever the rate of return your client's getting by 72, and that will tell them how many number of years it takes to double their money. So that's all it is. The rule of 72 tells you how long it takes you to double your money. And so you just want to take the interest rate, the return rate, divided by 72. All right, and in order to achieve a savings goal, you need to forego unnecessary expenses. Plug those spending leaks. That's where we have to have that wants and needs conversation, which is not always a fun conversation to have. But I think if it's done in the right way, when looking at a spending plan, then you can do it so that it's not as painful, and tie it to a long-term goal of theirs. And we'll talk a little bit more about long-term goals later in this presentation. But you want to start with making mini cuts. So small things, look at their bank statement. If they're going to Starbucks 5 days a week, maybe limit them to 2 days a week. try to curb their impulse buying. One way some people do it is leave their credit cards at home. Leave your ATM cards at home. So whatever they need to do to make it work for them, that's what they need to do. Avoid unnecessary bank fees. There are some banks where they will credit you the ATM charges if you use another bank. So that might be a place, that might be the one card they keep in their wallet, so if they need cash in an emergency, then they're not paying unnecessary bank fees. They also could look at reducing energy consumption. That's one way. I'll give you a personal example. I recently relocated from Iowa to California, and I knew my utility bill would probably go down some. I had no idea how much it would go down. In Iowa, I was paying about $300 a month in electric, and then probably another $100 or so for water. So about $400 a month in utilities. Here in California, I pay about $32 for electric and about $30 for, I don't pay for water, but I pay for trash, garbage pickup. So it's about $60 total. So I went from $400 to $60. Huge change. Now most people aren't relocating, and that I do understand, but there are other ways that they can reduce their energy consumption. And if you don't have a program at your organization, you can contact Cooperative Extension, who will have that sort of information available at the ready. And change expensive habits. So if you've got a client who's, again, we can use the Starbucks for an example. If they're doing 5 times a week, that's expensive at $5 a cup, when for $8 they could buy a pound of really good coffee and just make it at home. All right, so the next one is, let's look at a cost of a cup of coffee a day. And we're going to not assume this is Starbucks, because we're going to say this coffee is, let's try this again. There we go. This coffee is only $2 a day. So we know that's not Starbucks. But let's say they found a place and they're paying $2 a day for their coffee. A daily cup of coffee for a week would run about $14. And then a month, about $60.67. And then a year, they're looking at $728. Now, what if they invested that money? And I'm sure if you asked them today, oh, do you have an extra $800 to put into an investment account, they'd be like, oh, no, and I don't know where I'd get it from. But if you just forgo the $2 a day coffee habit, you're in there. So just a way of thinking about it. Now, let's look at this chart. This compares the cost, is showing us the dollar cost averaging, which is basically letting us know if you're investing $100 on a monthly basis, the cost of the shares will vary from month to month. So maybe in January it costs $10. And let's say February, maybe the cost of shares dropped to $8. So now you're able to buy more shares. March, it drops even further, $5. You're able to buy twice as many shares in March as you did in January. And then April, it goes back up a bit. You're 12.5. So you're averaging for 3 months $7.27 per share. And you're able to buy more shares than you would have had, had you not, as it changed per month. That's basically what I'm saying. So look, when you're doing this type of investing, you want to just know that you're putting the money aside. Don't worry about the fluctuation in price, because it's going to average out to the better on your behalf. That's basically what I'm saying. All right, let's move on. So this shows the process for saving. The first thing you want to do is assess where your client's at. Where are they today? Are they already putting money into a savings account? Is this a brand new thing for them? And then where do they want to be? It's going to be easier to help motivate your client to commit to a savings plan if you can tie it to a goal. So if it's something that's very important to them, then that helps motivate them to get it done. So that's one of the first questions you should ask them is what are your long-term goals? You know, what do you want to do? Are you wanting to save money for a house? Are you wanting to save money for your kids' college? That sort of thing. And then the last is the process. How do you plan on getting there? What tool are you going to use? As a general rule, savings goals should be sequenced in this order. You should start with an emergency fund, first and foremost. Once you've established that, then you can go on to pay down debt. Once you've got your debt paid off, then you start saving for the short-term goals and the long-term goals. Now you may, once the debt's paid down, depending on how much liquid you have, you may be able to set up a short-term goal fund and a long-term goal fund at the same time, which would be great. Now let's talk a little bit about an emergency fund, because that's going to be the lifeline of our savings plan. That's going to be our foundation, actually. And emergency fund is because, you know, life happens. Things just come up. And you want to make sure your client is prepared for it. And we're all very aware of life happening, right? With the most recent market meltdown in the mortgage industry and the increase in unemployment, a lot of people lost jobs. 2008 till today, a lot of people are still recovering. And so, rule of thumb is you want to have 3 to 6 months of living expenses. That's a general rule of thumb, just to be on the safe side. If you're not working, then you really want to have up to 5 years of living expenses, right? That's ideal in terms of, especially if you're on disability or if you're in a struggling economy like we were. I'm sure everyone wanted to have 5 years of living expenses. I actually know a gentleman who always had 2 years of mortgage payments in the bank. That was his thing. He always kept 2 years. But 3 to 6 months is where you really want to start. All right. Next are banking services. That's going to be part of the savings plan. You want to encourage your clients to use banking services effectively. So we've got a checking account, we've got certificates of deposit, money markets. You want to make sure they understand the benefits and the differences in those. Online banking, how that can benefit them. Low-cost credit can be useful. Any other financial products, of course, and then ATM debit cards, savings accounts, and clubs. These are all the things you want to have a general basic knowledge of so you can advise your clients effectively. And then you will find clients who don't feel comfortable using traditional banking products, and that's totally understandable. My grandmother was one of those people. Once she was on Social Security and they mandated a direct deposit, she would just take all the money out and then go to the post office and get money orders and pay her bills that way. But there are definitely some benefits to using traditional banking products. If not anything else, just check cashing fees, saving the money in check cashing fees. But it can be inconvenient for some people. Check systems, which if you've had an issue with the bank before, makes it really difficult to get another one. Some of the products are kind of complex. People don't feel comfortable maybe with money markets or CDs. Some banks have poor customer service, and if you've got a client who's gone to 1 or 2 banks and had to deal with that, then they may choose not to do that anymore. Hidden and excessive fees. Recent legislation has reduced it some, but still, you bounce a check and it's $36, and I know you're thinking, well, if I had the money in the first place, I could afford to pay it. I can't pay that and the $36, so it gets really expensive, right? And then, banks, just with what's going on with Wall Street these days and what's happened previously with our economy, there's just a huge lack of trust. So there's some real barriers to overcome with many of our clients, and our job really is just to educate them. So when you're saving for short-term goals, these are the products you want to look at. You want to look at a savings account because it's a low-risk place that they can set money aside, earn some interest. It's not really designed for frequent withdrawal, so that's why it's a short-term. Like a good example would be a Christmas Club account that many banks and even credit unions offer. So it's not something you're going to withdraw money from frequently. You'll put it in, and then at the end of the year, you'll pull it all out. So best for short-term goals as well as emergency funds. There's also savings accounts, which can encompass a CD, money market, other savings accounts, excuse me, CD, of course, depending on the time. That could also be, you wouldn't really use a CD for a Christmas account, though, because Christmas accounts usually allow you to deposit several different times, where CDs, usually you just put the money in and let it sit there for a designated amount of time. Money markets are kind of like checking accounts, so but they earn a higher interest than regular checking, so that might be a way for your client to go as well. Usually money markets require a larger deposit, though, so that may be cost prohibitive. And then, of course, you can always use a checking account. Some checking accounts pay interest, some don't, so you want to be mindful of that. Excuse me. You can go to bankrate.com so you can understand requirements and fees for your checking accounts. Make sure if you've got a client who's never had a checking account before, that you are educating them on how to balance their checkbook. And nowadays, most people do it online. Not everybody, but most people do it online. So if you can just show them what tools their bank offers, or set them up on a on a spreadsheet, a budget spreadsheet that tallies their expenses, that could be a way to do it. There's a few apps if they have smartphones, like mint.com, which can be very effective as well. But make sure you add that piece of education to it if they're not really comfortable using a checking account. Using a checking account, or if you notice that they've got a lot of NSFs, non-sufficient funds charges on their account, you may want to provide some education there. All right, next are bank services. Bank services, main thing you want to educate your clients on is that they're safe from loss or theft. The FDIC and the NCUA insure up to $250,000. Now, if your client reaches that limit, then they can just open another account and start putting the money into that one, so that they always have that $250,000 insurance. It makes bills payments really easy and inexpensive. I can attest to that because I pay almost all my bills online, and it's very convenient. I can keep track of them. I can see when the last one was paid. If for some reason a payment gets missed, I can go online and have them research it and get it fixed, usually without any cost to me. And like I said earlier, you can avoid costly check cashing fees, and you can turn to Table 63 in your book for more information on that. It helps you maintain a record of all the financial transactions when you do it online. Convenient, direct deposits, and many banks won't charge you a fee if you have your paycheck direct deposited. Plus, that way your paycheck goes on like in the middle of the night or early in the morning the day you get paid, versus waiting to get an actual paper check and then still having to go to the bank and deposit it. So it's very convenient. They allow you to build a savings and earn interest, and you can see that grow online. With banking services, you have access to mortgage loans, car loans, other financial products. And if you're using low interest credit, it can help you establish a positive credit rating. So there are some benefits. The other financial products are like prepaid cards, payroll cards, gift cards, money orders, all other financial products that you may use when you're counseling your clients into what's the best way for them to save. And really, there's no cut and dry method, so you have to just look at their situation and see what's going to work for them. Now let's look at investing for long-term goals. As we continue to build the plan and focus on your client's longer-term goals, a client may need to consider investing as an option. Not everyone has the proper appetite or aptitude for investing, but investing should at least be explored as part of an overall general plan that you're going to work with your clients on. It's important to understand the relationship between risk and reward, and it's very important not only that you understand it, but that you're able to communicate this well to your client. Longer-term goals may be able to afford assuming higher risk, because they're going to be in there a long time. It'll allow for time for the market to recover. Conversely, for short-term goals, clients should consider less aggressive investing options to reduce the risk of losing their principal, while at the same time understanding that there's a possibility of a lower return. So less risk, less return, higher risk, more return. That makes sense. A certified financial planner or financial advisor can help guide your client through that whole process. And as a financial counselor, your role is to inform clients of just basic investment principles. That's all. Why investing is important, and then how it can fit in their overall financial plan. So that's all we have to do. We just want to share basic information. We are not there to actually advise our clients on which investment tool they should use. We should leave that to the certified financial planners. So let's talk about investments and when they're appropriate. They could be appropriate for funding college education, home ownership, retirement, wealth accumulation, of course, and other long-term savings goals. And we'll talk about that a little bit later on. You want to educate your clients, but do not provide, like I said just before, specific investment advice. Refer them to a certified financial planner. And I want to say it's going to be very important that you vet your financial planners. Try to find one that someone that you trust has referred to you. Make sure you refer them to at least 3 so HUD doesn't get upset with you. And get to know them. Sit down, have them come over, maybe do a training with your staff on just basic investment programs so they have an idea of how their organization works. Because remember, anybody you refer to your clients is an extension of yourself. So you want to make sure it's someone who's going to take care of your clients and make sure their best interest is being served. So here are some tools for long-term investing. Bonds. And bonds, of course, when you buy a bond, you're lending your money basically to the government, to a municipality, or to a corporation. Whereas stocks, when you buy stock, you become an owner, a part owner of a company. Most clients will not have sufficient cash flow or the ability to invest appropriately on their own, because it can take a great deal of money, time, and expertise to invest adequately and appropriately. So most working families, unfortunately, lack these qualities. So what can they do? They can look at mutual funds. Again, a financial advisor will probably advise them on the best one to choose, but the concept with a mutual fund is they're pooling money from many investors to increase purchasing power. So a mutual fund may not have as high of a minimum deposit amount as going directly to a bond or a stock. And it helps spread the risk, right? Because there's a lot of people investing. If 100 people are investing $1, it's a lot less risk to me than if I, as one person, am investing $100. Funds also have varying degrees of risk as well as different strategies that they promote. They also have costs and fees associated with owning them. So that's something they need to be aware of. So how do mutual funds work? Well, investors purchase fund shares. So they're not purchasing stock shares, they're purchasing fund shares. And then there's a fund manager who invests those shares based on whatever strategy the fund has set up. So you may have a fund that's set up to invest in female businesses, or you may have a fund set up to invest in, green technology. So that manager will look for securities that he can invest based on that strategy, whether it's women or green technology. And then as the income and returns come in, those are provided back to you, the investor. And dividends and gains from the investment, of course, and then it comes back to you. Or if there's a loss, it doesn't come back to you, but at least it's split out so you're not losing a huge chunk of money. You might be losing a small percentage. Investors can purchase mutual fund shares directly from the fund or through a broker. And the price that the investors pay for shares is the fund's per share net asset value plus any commission or transaction fee. So you're paying that value plus the fee. Mutual fund shares are redeemable, meaning investors can sell their shares back to the fund. So that's nice. They can get out if they need to. Some of the attractive features of mutual funds: professional management, because you've got a fund manager who's running the whole thing. Diversification. Your fund could be, the strategy of your fund could be such that you're diversifying how your money is being spent. Affordability. You're not having to put that whole $100 in. Maybe you're putting $1 out of 100 people. And then liquidity, because you can redeem your value back from the fund. So funds are kind of nice. Some disadvantages of mutual funds: cost. Investors must pay sales charges, annual fees, and other expenses regardless of how the fund performs. So if your fund's performing well, usually we don't mind so much. But if it's not performing well and you still have to pay those fees, that can be a little frustrating. You may also have to pay taxes on any capital gains distribution that you receive, even if the fund went on to perform poorly after you bought the shares. So that's something to keep in mind. There's a lack of control. Investors typically cannot ascertain the exact makeup of a fund's portfolio at any given time, nor can they directly influence which securities the fund manager buys or sells. As long as the fund manager is basing it on the strategy of the fund, then it's up to their discretion. Price uncertainty. With an individual stock, you can obtain real-time or close to real-time pricing information with relative ease. You can check online, you can call your broker, etc. You can also monitor a stock's price change from hour to hour or even second to second if you've got that kind of time. By contrast, with a mutual fund, the price at which you purchase or redeem will typically depend on the fund's net asset value, which the fund might not calculate until many hours after you've placed your order. In general, mutual funds calculate their net asset value once a day, typically after the U.S. market exchange closes. And then, of course, there could be tax consequences, which we talked about already. So most mutual funds, they fall into one of three main categories: money market, bonds, funds, and stock. And as you can see here, this shows a really good, just basic idea of the differences. The money market is good for short-term investments. They strive to maintain at least $1 net asset value per, and risk is relatively low. On a bond, they invest in various types. They pursue higher yields than money markets. And then the stock, which historically perform better, they're going after different types of stock: growth, income, index, sector, etc. Losses are rare on the money market, but still possible. There's still a risk of inflation. Bonds, a little higher risk, it varies, but higher risk than money market. And then stocks, of course, is a market risk. Values can rise and fall very quickly. So if you're going to be more conservative, you'd probably go towards the money market. And if you're going to be more aggressive, maybe for long term, you go for the stock funds. Now let's understand risk, since we just kind of talked about it. With any investment, you want to make sure you educate your clients that they could potentially lose all of their investment. It's not FDIC insured like banking products are, or like banking accounts, I should say, because stock could be a banking product. But the values may fluctuate significantly. So I think early on we talked about you need to assess, do they have the stomach for this, because they need to be in it for the long haul and just invest the same amount every month for 20, 30, 40 years. Dividend and interest payments can also change, and they just need to have a grasp of their risk tolerance. If they don't have a high risk tolerance, they probably shouldn't go very aggressive. If they do have a high risk tolerance, like I said, we'll go back a slide. If they have a high risk tolerance, they can go for the stock funds. If they don't, they probably want to stick with the money market funds. It'll be a lower return over the long haul, but it'll be slower and steady. All right. Now, how do we manage this risk? Well, there is a way. You can select the appropriate mutual fund or a combination, which is kind of nice. So this gives you an idea, and many funds will show you, okay, if your investment strategy is to be conservative, you can choose the conservative option, and these are the types of funds we're going to put our money into. If you want something kind of 50-50, which is what's highlighted here, you've got something in the middle. Remember, your role is only to educate clients on options and concepts. Never make recommendations on investment products. Always refer them to a certified financial planner. Again, time in the market is more important. So as you can see, all these squiggly lines, they all started off at $1 in 1926. In 2010, Let's see, the yellow one, which was large company value stocks, is at $12.92. The blue one, which is small company stocks, is at $20,529. So, but if you see, the blue took a drop, yellow took a drop, and then yellow, I'm not sorry, I meant orange. Orange did not take much of a hit, where blue and yellow plummeted. So folks who were probably risk averse would have sold right then. But if you look, the people who bought blue and yellow and stayed in, they made the most money. All right, now let's move towards retirement accounts. Did you know that retirement can last up to 30 or more years? Isn't that wild? Because you think about it, if someone retires at 62, it's not uncommon that they can live to be 92. And the common rule is to follow. The common rule to follow is that a retiree will need about 80% of their current income to live comfortably. And according to Social Security Administration, that average benefit, according to the IRS, the average Social Security benefit is $11.77. How many of your clients do you think can live off $11.77 a month? Interesting question to ask. But think about it. If at this point their house is paid off, all their debts paid off, then maybe that's possible. And if it's a two-person household and they're making double that, then that could be quite comfortable. So let's talk about the different types of retirement accounts. There's a IRA, a 401k, and a 403b are the ones that receive special tax advantages. So that's always really nice because they're pre-tax. And what actually happens, well, we'll talk about that when we get to it. I don't want to get ahead of myself. So typically, contributions are pre-tax. Taxes are paid on distribution. So when you take the money out, you pay the taxes on it. There's a 10% penalty that applies if the money is withdrawn before 59 and a half. Usually provide investment options with various strategies, so depending on what you feel comfortable with, you can make that selection. There's usually a required minimum distribution starting at 70 and a half. And then the IRS Savers Credit, and that's a tax credit that helps low and moderate income workers save for retirement. All right, so let's look at the different IRAs. There's a traditional, a Roth, a rollover, and a spousal. The traditional is pre-tax dollars, which is really nice. They're taxed when the funds are withdrawn. They can choose any asset, but there's a 10% penalty for early withdrawal. The Roth, on the other hand, is an after-tax contribution. So you've already paid taxes on it. This is the money you have, and now you're investing it. The qualified withdrawal is not taxed because you've already been taxed on it, right? You may withdraw principal without a tax or a penalty. You must wait at least 5 years, though, from the first deposit. So if you started depositing in 2000, in 2005, you could pull money out, no penalty. And the required minimum distribution does not apply. So that's nice. On the rollover, that's used to transfer from an employer to an IRA. So if you've got money that you put aside in a traditional at a job and then you leave that company, you can roll it over into a regular IRA, a rollover IRA. It provides greater control of your investment. So that's kind of nice. And then there's the spousal one, where if your spouse is not working, they can you can deposit on their behalf, but you have to check with the IRS on the contribution limits. Now you can set your IRA up with a bank, a life insurance company, a mutual fund, or a stockbroker. Employer-sponsored retirement plans consist of the 401k, which we're probably all most familiar with, the 403b, which we see a lot with state employees, government employees, the simple IRA, profit sharing. They may provide employer contribution, which is really nice, and but you want to know when you become vested, meaning when does their money become your money. So some companies it's 5 years, some companies it's 1 year. Yes, you want to know that. They may allow you to borrow against those funds, and there may be qualified distributions as well. We also have, as another tool for saving, annuities, which is a contract between an individual and an insurance company. It can be purchased in a lump sum, or you can make payments. It is tax-deferred growth. So the withdrawal is taxed as your ordinary income, not capital gains. It also provides a death benefit, which is nice. Withdrawal payments can last a lifetime or continue to a surviving spouse or beneficiary. It is definitely a long-term investment. And what you want to advise your clients is make sure they understand the fees, charges, and the features of an annuity. Like I said, it can have all these things that we've just listed, so you want to make sure that your client understands which one they're getting. So there's fixed, indexed, and variable. And just like mutual funds, the fixed is going to be more conservative, less risk. The index is going to be kind of a combination of the two, and the variable is going to be a higher risk but could possibly lead to a higher reward. So those are the basic things of the annuities. The fixed, for instance, has a specifies a minimum interest rate that they're going to get paid. The index does the same thing. The variable does not. The fixed has a predetermined payment schedule. The index does the same thing. The variable, again, does not, because you may not have money coming in. You could lose your principal on the variable. So just make sure, again, they understand the ins and outs of what they're getting into. And like I said, refer them to a certified financial counselor, planner. Yes. All right, so another tool is saving for college. I think a lot of us have heard of the 529 saving plan. There's a 529 prepaid tuition, the Coverdell ESA, as well as some other considerations. So let's talk a little bit about the savings account. It's after-tax contributions, it's tax-deferred growth, tax-free qualified withdrawals, which is really nice. There are a variety of investment options, so you've got some control there. Additional benefits vary from state to state, and there is some market risk. On the prepaid tuition, you pre-purchase of the tuition at today's rates. So as we know, school tuition seems to keep going up and up and up, so you can prepay that and have it set for them. The performance based on tuition inflation, of course. You may have limited college and university options because all of them may not participate, but you don't have any market risk, so that's nice. With the Coverdell, you can use funds for elementary, secondary, or college. You have more investment flexibility. It's also tax deferred, and you get tax-free qualified withdrawals, and there are lower contribution caps, so that's nice. With the other consideration, we've got the UGMA, which is the Uniform Gift to Minors Act, and the UTMA, which is the Uniform Transfer to Minors Act. You've got money markets, you've got CDs, you've got USA bonds, whole life insurance, all sorts of things. With those first two, you just want to check with the IRS and see what those guidelines are, as they can vary. Next,